the weekly market wrap today is March the 12th. The time right now is 8 o'clock in the evening. And like I say, welcome to another episode of the weekly market wrap. This week, we have quite a bit of volatility in the market. And I think this week is going to be pivotal in the sense that something big really happened and it may cause even more volatility in the weeks ahead. Starting tomorrow. So be very, very focused on what you do in the marketplace in the coming week, because like I said, something major has actually been broken in the marketplace. And this could actually be the basis for the market volatility going forward. Now, to begin, this presentation is definitely not a offer to buy or sell any kind of securities. And the trading of any kind of leverage products to carry risk, and do be aware of your own risk profile before you attempt to trade any of the leverage products, be it FX, futures, options, CFDs, currencies, or even cryptocurrencies. And of course, I'll be sharing with you my views on the various markets, and do note that those are my views and have nothing to do with my company, Traders Academy International, and I will not be responsible any action that you may take. So just to confirm that you can hear and see me, can you just type yes in the chat box so that I can understand that you can hear and see me? Thank you very much. Now, like I said, this week something big happened. On Tuesday and Wednesday, we have the Fed Chairman having his biannual testimonial in front of Congress. On Tuesday, it was a testimonial that lasts over 2 days with 2 separate subcommittees within the House of Representatives. So on the very first day of the testimony, which was on Tuesday night, what the Fed chairman did was came across as very hawkish, because he made a statement saying that prices are still not coming down. Remember, about 1 month back, during the last FOMC, not this month FOMC, he did mention that disinflation, and he mentioned that disinflation word several times in that speech after the rate hike on at the beginning of February. And during this latest testimony, this word did not appear anymore, because since then the market has been releasing numbers that suggest that prices are still elevated, and there are signs that says that inflation in the States is coming back up again. So we can see that this inflation word that he had been using post FOMC meeting on February the 1st did not appear anymore. So market has been worrying for quite some time now, because of to date, we are right now in March of 2023. Remember, exactly 1 year ago, just right after the war breakout in Ukraine, the Federal Reserve actually started their rate tightening cycle, and the timing was quite coincidental, because signs of inflation were actually quite evident in the months leading to 2022. Okay, in fact, signs of inflation were actually rearing its ugly head as early as October 2021. But he has been maintaining that inflation is going to be transitory and nothing to worry about. And just right after the war breakout in Ukraine, you can see the Federal Reserve started a policy reversal in which they take interest rate from near zero all the way to currently just about 5%. Okay, so right now we are seeing the total reversal of a monetary policy, and because of the very aggressive rate hike that the Federal Reserve has been doing since March of last year, market participant has been very worried that at some point something is going to break, because usually when you want to tame inflation, you want to give market times to prepare. But this time, I think the market wasn't prepared for such an aggressive rate hike to the point whereby a lot of financial institutions has been caught flat-footed. Because in the days before the rate tightening cycle, remember, US interest rates was near zero, and it stayed that way for more than 2 years right after the pandemic. And a lot of banks, because interest rates were near zero, they couldn't get any kind of yield, and they couldn't put the money any elsewhere. So what they do is that they have been buying the long dated US Treasury bonds, because interest rate is zero. If you buy the longer dated bonds, you get something out of nothing. Okay, maybe it's as low as a quarter point, but it is better than zero yield. Okay, so a lot of financial institutions actually have parked their money in long-term U.S. Treasury. So this is the basis for the this week's debacle in the banking sectors. Okay, so we will be covering that as well. Okay, so I'm sure by now you probably have heard about these two banks. Okay, now before that. I want to remind you tomorrow onwards, we are back to daylight savings. It means the market will open 1 hour early. So be sure that you're going to be in front of a screen if you're trading US equity markets to be in front of a screen before 8:30 because this is the biannual change in the clock itself. So the clock now will move forward by 1 hour. Okay, just be sure that tomorrow is the start date. Now, I am mentioning two banks here. These two banks are not big banks. They are called regional banks, and they are all located in California. And one of them is actually more crypto related. Silvergate Bank is actually crypto related. In fact, the problem with Silvergate has been ongoing for quite some time, but it finally come to a head because after the FTX exchange collapse, they have quite a bit of exposure to FTX as far as Silvergate is concerned. So they come to a point whereby they actually announced right after the Tuesday Fed Chairman testimony in front of Congress, and they came out with a statement and said they are filing for they're filing for voluntary liquidation. Okay, so that was the first shock, but the market wasn't like didn't take it very, very seriously. Okay, so it was the first announcement of a bank that fails in the States. Now, the last time a bank failed was, if you remember, Lehman Brothers. That was 2008. That was the last time any kind of bank in the States actually failed. So when Silvergate said they are going into voluntary liquidation, they couldn't hold the line anymore because the crypto market has been in a state of it actually rebounded, but the rebound was actually canceled out much of this month. So we can see that business was bad and there were a lot more withdrawal. And Silvergate did the what most banks in the States did. They have parked most of their reserve in long-term US Treasuries. So remember, when you buy US Treasuries, mean you are preparing to hold on to a yield, but the commitment is for at least, depending on the duration. If you're buying the 30 years bond, you got to hold until maturity. So in a sense, those kind of debt does not show up, because what happened is that since then the interest rate has gone up to almost 5%, right? So if you're holding on, if you're locked in your reserve to at a quarter percent, where now the real interest rates has actually climbed to almost 5%, you are sitting on the paper loss. But they did not consider this as a loss, because in the US they have this accounting rule called hold to maturity. So assuming you hold this reserve all the way to the to maturity of the treasury bonds, you actually did not incur a loss, because technically you don't incur a loss unless you start to sell them. So what happened was that there's a lot of depositors has been pulling out their funds to the point whereby, you know, in order to survive, they had to sell off some of their reserve, which is selling those US Treasury at a loss. And this comes to a point whereby the business model no longer is viable. So they have announced that they're closing for good in the middle of the week itself. So that was the first inkling that we're going to have problem because of the Fed very aggressive rate hike. Because when you have very aggressive rate hike without giving financial institution the time to actually adjust, then, you know, they like a trader who are caught in the wrong position, they did not cut loss and they hold on to it, hoping that something miracle will happen. And they, like this time, nothing of that sort happened, and they have to call they call it a day. Okay, then the following day, on Wednesday, another bank make another statement, say that they may have problem as a going concern, and this bank is much bigger than Silvergate. Now, Silvergate was actually started in 1988. Okay, the other bank called the SVB, which is the Silicon Valley Bank. Okay, it is a bank that is a lot bigger than Silvergate, and they have $209 billion in asset. So you would think that such a well-capitalized bank should be okay. And to to make it worse, a month before this month, the Forbes magazine actually came out and list the all the banks in by ranking, and SVB, this Silicon Valley Bank, actually came in top of the ranking. Okay, and their model has been to service the venture capitalists, okay, and the startups. So there's a lot of very aggressive startups, has all been set up in Silicon Valley in California, right? So this bank, although we do not hear too much about them, is actually very big in the States. Almost 44% of all startups and venture capital have a bank account with SVB. Okay, so very much like Silvergate, they also are a victim of this very aggressive rate hike by the Federal Reserve, because they actually started banking back in 1982, if I'm not wrong. So it has been around for quite some time, but their main focus has been to service the venture capitalists and the startups. Okay, so they also lock in long-term US Treasury bond with their reserve, and if very much like the victim of Silvergate, as interest rates start to climb, they are beginning to see that the scene in the startup scene has become largely damaged by the lockdown during the pandemic. And even while the lockdown has been removed, you can see that the business did not quite pick up, because last year we saw tech stocks were under a lot of selling pressure, and that caused a lot more startup to actually do withdrawal rather than to park more money with them. So they are facing with more higher level of withdrawals, and then in order to service those withdrawals, they will have to sell off those long-term bonds at a loss, and come to a point whereby when they issue the statement on Wednesday, say that they may have problem as a going concern. Those venture capitalists, the more alert ones started to withdraw their funds from them. Okay, I'm not sure whether you heard of this guy called Peter Thiel. Peter Thiel is a co-founder of PayPal. He's also a CEO of Palander Technology, and he's also the CEO of Founder Funds. And he was one of the very first to withdraw all his funds from SVB. And word gets around, and more people went to SVB to withdraw their funds, and that caused a crisis. Now, within 48 hours of them announcing that they are going to be concerned as a going concern, the FDIC, which is the federal those agency in the States that actually guarantees customer bank deposits, came in to shut them down. Now, this is very, very fast. Normally, when the FDIC want to take over a bank, it will take months, but this time they only took them 48 hours before they move in to close down the bank. So what happened right now, now markets are closed. In fact, on Friday, the stock is no longer listed for trading, and it has already collapsed. Now, the main question is, there's a lot of venture capitalists who have accounts with this bank, and most of the funds now are frozen because the FDIC has seized all assets. Now, the question here is, a lot of regional banks, the not so well-known one, okay, now under the spotlight. Will this cause further bank run? There is a bank run going on right now in the States, and tomorrow when the market opens in the States, we will see how bad is bad, because if this fear of contagion spreads, it will actually cause a global contagion, because this have ripple effects. So right now we are seeing this as a major breaking point, and you see the week itself actually swing from very pessimistic to optimistic to pessimistic. So when the Fed chairman came in on Tuesday night to coming across as very hawkish, the market revised their expectation of a 50 basis point rate hike tremendously, okay, from near 0 to 30%, and then by midweek it was at 70%, thinking that the Federal Reserve would have to hike interest rates, reversing what they did last month when they cut interest rate from 50 basis point to 25 basis point. So there was this fear, and what the market did was the market actually came off. Then on Thursday, the market came off even further, and then of course on Friday we saw the market actually was waiting for the non-farm payroll. Non-farm payroll came in. It's actually not a bad number because it didn't come in as aggressive as what we saw in the February numbers. Okay, so the thing is, but this fear of contagion actually overwhelmed the market, and we saw the market closes on the weak note. So the fear right now is, will Monday bring another bloodbath? There is every possibility that this time is different. So we want to watch these unfolding events. And Raja Kumar is asking, when interest rate increases, it should help bank, right? Yes, that is usually what you would think, okay? But we are living in unusual times right now. Now, the theory says that if interest rates goes up, banks should be the beneficiary because now they can charge higher loan rates. But don't forget, a lot of banks gone through a very low zero interest rate environment for a very long time. For more than 2 years, the banks were dying because most of their they are not making loans anymore because the interest rate is so low, it doesn't pay for them to extend loans. So what they do is they have actually pivot to parking their excess fund in US Treasury, and they have parked on the long end because before we see the rate inversion between the 2 and the 10 years, interest rate in the longer term, longer dated bonds were actually higher than the shorter dated bonds. Right now we have the exact opposite. 2 years bonds actually fetch more yield than the 10-year bonds. So right now this is causing a big problem because when the banks are locking at lower rates, as interest rates goes up, they cannot access those funds. They get to hold to maturity at least. So you can see their funds are all locked up for in the long-term bonds. So for the big banks, it's not too much of a problem because they got other revenue generating portfolio. Whereas companies like SPV, they are so focused on one segment of the economy, which is actually what we call niche banking, because they are servicing the startups and venture capitalists. They do not have other revenue source. You know, they actually try to go into mortgage itself, but we all see what happened is that the property market in the States actually more or less collapsed. So there is very little demand for mortgages. So that division was actually closed in December of last year. So we can see that yes, theoretically, higher interest rates should benefit banks, but right now we have a situation in which the banks are locked in at a lower yield, whereas currently we can see that interest rate is a lot higher, and the yield, if they go and buy the short end bonds, we actually fetch a lot higher yield than what they could have got just 1 year ago. So there is a lot of problem here. So this situation here has been turned on its head. Okay. So be aware of the general climate out there. You can see that the extended and very aggressive rate hike has already impacted businesses all over the world, and not just in America, but what now we are beginning to see something is being broken here. Okay. Now let's move on to the various economics data that were released this week itself. On Monday itself, we have Eurozone. We have their retail sales. Retail sales wasn't as great. They expected a 1% bump up in retail sales for the month of February on a month-to-month basis. It came in so much lower at 0.3%. So that was a dampener. And on a year-to-year basis, it went negative. They were expecting almost 2% growth. It came out negative 2.3%. So that was actually quite surprising. And that means that Europe is definitely still smeared in a very low growth environment, because the Europeans are definitely feeling the heat of very elevated prices, so they are not spending as much. So this one is quite understandable. Okay, so it also shows us that Eurozone itself is actually probably already in recession for all we know. Okay, then what we see here is on Tuesday itself, we have Australia. The trade balance actually improved. Not improved lah. They actually came off a little bit from last month. They were actually expecting a slight improvement over December numbers. It came in at 11.68 billion Aussie dollars when the market was expecting 12.5 billion Aussie dollars. So that was a bit of a dampener. It wasn't as strong as they like, but it wasn't that bad. It is still not it is still a respectable number. So this release did not very much impact the whether the Aussie market or the ASX, which is the Australian stock market. Then we have the what I call the RBA, which is the Reserve Bank of Australia, releasing deciding on interest rate hike. This is now within expectation of 3.6%. So you can see the curve. Australia is one of the very few that actually came in late in terms of the rate hike. They actually started to hike rates after the Federal Reserve has done it in March of last year. So you can see the first rate hike was actually in May. So they were actually behind the curve. So they have been keeping at it for in terms of every single month they have been hiking rates. So right now the interest rate is at 3.6% in Australia. Okay. Now, this is exactly what caused the market to come off on Tuesday. We have the Fed Chairman testimonial in front of Congress, and he came across as very, very hawkish, and the market actually wasn't expecting him to make the kind of remark, although because earlier on I did mention in the last FOMC, post-FOMC meeting, he actually was talking about disinflation, meaning to say that he see prices coming down and there are evidence of lower prices. And that's the reason why market become very complacent, thinking that, oh, they're going to be pausing the rate hike for the March FOMC, which is coming up on March 22nd, meeting next week. 2 weeks from now. Okay, so we can see that the market wasn't prepared for such a hawkish testimonial, but he came in to be particularly hawkish, and the market actually took a tumble, because when you have higher rates, it is definitely a negative for equity markets. So that set the tone for the entire week itself. So on Wednesday, when he has continued his testimonial in front of a different committee, that one does not have any impact. But that day, remember that day was where Silvergate announced that they are going to voluntary liquidation, and also the date in which the SVB actually was trying to raise fund. Okay, they were trying to raise fund. I think they are trying to raise something like $1.2 billion. They couldn't raise it in time, and the market sink. Okay, their stock value sink 60% on the very date itself when they announced that. So that was how the market reacted quite badly to news of a major bank that services one very niche market segment of the economy, basically saying that they are in trouble. Okay, so as more and more people go in to withdraw their funds, we begin to see a sort of a bank run going on. Okay. So on Wednesday, we have retail sales again for Germany. Earlier on, that was for Eurozone. It didn't come in as well. They were expecting a very positive number at 2%. It came in at negative 0.3. So that was a disappointment here. And then the retail sales from negative 6.1 dipped further to negative 6.9. So we can see Germany retail sales is a mirror of what the entire Eurozone is facing, basically weak demand. Okay. And again, we see Euro area was actually announced their GDP revision. Again, there was no surprise here. They're expecting no growth, and this is exactly what they get for fourth quarter of 2022. And on a year-to-year basis, it actually dipped a little from 1.9% previous estimates now to 1.8%. So we can see that on a quarter-on-quarter basis, you can see that the Eurozone economy is now stagnant. Okay, there is hardly any growth. And then on Wednesday itself, we have the advanced, we call that the ADP numbers. Okay, this is usually a reflection of the private employment situation in the States, and this is a number the Federal Reserve would not want to see, because they have created even more jobs. The market was expecting 200,000 jobs creation. They came up 242,000. So again, this is not a good sign. And then they revised another 13,000 higher compared to the January number. So we can see in January, the new job creation was 106,000. Now, but the revision for the month of January is they revised upwards by another 13,000 new jobs. So by and large, this is definitely not a good number for the Federal Reserve, meaning to say that they have no choice to prepare for non-farm payroll to be an ugly number. Okay. So in Canada, we also saw the rate interest rate decision. This time, the BOC, which is the Bank of Canada, actually is among the very first G7 central banks that actually pause interest rates. They hold it at 4.5%, which is within market expectation. So we can see the Bank of Canada actually also started to hike rates around the same time as the Federal Reserve, but they have decided that they want to pause the rate hike first ahead of the Federal Reserve. So I think going into this week, before the bank run that we saw in the States, I think the Federal Reserve is actually prepared to actually do the same thing, maybe to pause the market and see how the market reacts. But now I think their hands are being forced. There are already talks that the Federal Reserve may not even be able to hike interest rates at all, based on the banking crisis that we are seeing. If these things escalate over the next 2 weeks, they may be forced to pivot, meaning to say to cut interest rates. So rather than the market from thinking that the Federal Reserve is going to hike interest rate by 50 basis points, now they are thinking maybe they have to cut right now. So would that be good or bad for the equity markets? So normally when the cut rate is definitely a shot in the arm for equity markets, but the underlying reason why they are cutting rate is telling the market there is a wider sickness in the market. So would you dare to buy equities when the Federal Reserve have to do an abrupt U-turn? That means to say that they are signaling there is real problem in the economy. So again, don't be too happy if they suddenly reverse the monetary policy and start to cut rates. Okay, so you just really have to not trade based on the usual response of interest rates, because when you cut rates, typically it's good for equity markets. But this time, there is a real problem in the economy. If this bank run that we are seeing spreads to all the other minor regional banks, the next bank that people are already focusing is a bank called Signature Bank. Okay, it's again a regional bank, also very much involved in the crypto markets. So we want to see how bad is bad, because even the major banks like Wells Fargo and JP Morgan, their stock price actually moved down quite a fair bit on Friday. So would it spread to the larger banking sector? If it does, it will have worldwide repercussion. So you want to get out of financial as fast as you can, because I think most of the algos right now are geared to trade to the downside already. Okay. Raja Kumar is asking, so bank move to making investment instead of financing business. That is a problem. When interest rate is zero, that will be the idea that you want to, you see, when interest rate is zero, there must be a reason why interest rate is zero, because there's simply no demand for funds. Okay, so if that's the case, the bank cannot make money from doing the usual loans. Okay, so what they do is that instead of lending out to individuals and corporations, because they are also worried those banks and individual, the consumers may not be in a position to repay. We are also beginning to see what I call that, delinquency rates actually increasing in the States. We can see that in the housing market already. Americans are no longer able to finance their real estate, has been basically not been paying. So you see, these are all being swept under the carpet. So we are beginning to see a little bit of 2008 all over again. So this could snowball into something really, really big. Okay. So we will have to see what are the responses. Okay. In Japan, we have the release of the GDP estimates. This time is even worse. They expected a 0.2 GDP on a quarter-on-quarter basis. It came in zero. Again, no growth for the fourth quarter of last year. And GDP on a year-to-year basis is only at 0.1%. Where the market was expecting 0.8. So we are beginning to see totally flat, no growth whatsoever, whether it's on a month, on a quarter-on-quarter, or on a year-on-year basis. So Japanese economy is definitely in a stalemate right now. Okay, there is simply no growth. Over in China, we can see that the consumer price index actually took a nosedive, which is actually a good sign. But that could also mean an underlying problem. Why is the consumer prices dropping the way it did? Because market was expecting 0.2 for the month of February, but it came in negative 0.5. So this is on the surface, it looks like a good thing. Okay, but you have to consider, if consumer prices drop the way it did, it means is it a reflection of the lack of demand in China, okay, among the US, the Chinese consumer? That could be a mitigating factor. So we have to watch how the market reacts. On a year-on-year basis, it only grew 1% compared to market expectation of 1.9%. Now, this number, if it's transferred to the United States or any of the other G7 economy, that would be fantastic news. But coming in China, where the market will have very high expectation of China because of their reopening, they want to see if China can be the ballast that can buoyant, that can compensate for the lack of growth in the Western hemisphere. So right now we are beginning to see consumer prices coming back down. It could be a sign of some serious internal lack of demand. So that is definitely not a welcome sign if you look from the perspective. BOJ, of course, nothing changed here. They have maintained their interest rate at negative 0.1, and the new this will be the last BOJ announcement before the current governor of the Bank of Japan actually steps down. He is expected to step down on April the 8th. The new governor is a guy called Ueda. He has already mentioned that he's going to maintain the current monetary system policy, which is to keep the monetary easy in order to continue with the existing policy. So the market right now do not expect this new governor to do any kind of big move basically in the Japanese monetary policy front. Okay. Over on Friday, we have the harmonized index of consumer prices for Germany, and we can see there's an uptick here. So we are beginning to see not only in the States, we are also beginning to see uptick in terms of retail prices. In Germany, month on month, is actually went up to 1% from 0.5. Market was expecting an increase to 0.8, but it came in hotter than normal. So we're now, based on the January number of 0.5, we have a doubling of the consumer prices in Germany itself. On a year-on-year basis, it remains stable at 9.3%. So this is definitely not something that they would like to see. They want to see this number go down drastically. At 9% is still very, very hot. Okay, so we have no growth and we have high prices. That means Germany, as well as the entire Eurozone, is staring into a stagflation in which you have elevated prices and practically no economic growth. Now, stagflation is very, very troublesome because stagflation is very difficult to overcome. Okay. Now, when we look at the US non-farm payroll, it came in a lot hotter than the market expected. Market was expecting 200,000 new jobs creation. Remember the last time they reported this number was 517,000 jobs. Now their market expected a revision to the downside. So 200,000 new jobs creation was actually a revision downside, and they came in 311,000, still a bit hotter than what the Federal Reserve would like to see. So we can see that it is problematic for the Federal Reserve because demand has not effectively been curtailed. They need to see higher unemployment rate. They need to see less job creation, in which they ideally want to see negative job growth. Okay, so that will reinforce what they want to see. So by and large, unemployment rate is good because it's actually going in the direction that they want to see. Unemployment rate has bumped up from 3.4% to 3.6%. So we are beginning to see some kind of impact of the very aggressive rate hike in terms of the unemployment rate. We are beginning to see in the white collar sector, the service sector, the tech sector, the layoff is beginning to show up in the numbers. Okay, so not so much in the services segment yet, but I think in the high tech sectors, we are beginning to see a lot of tech firm has been announcing what we call layoff. So we are beginning to see those numbers being shown in the numbers itself here. Okay, so Canada also report the same thing. Okay, here I have not updated. It came in at 10,000 new jobs, and unemployment rate is at 5.1%. Again, we are beginning to see more people being unemployed in Canada. Michigan consumers sentiments, I have not updated for some reason. I'm so sorry. Here I have not updated. I don't know what's the reason. What was the latest number? So there you have it. By and large, all these economic numbers has all been overshadowed by the bank runs that we are seeing in the States. So that will be our major concern going into the new week. Will that cause even more a drastic sell-off in equity markets. It's already affecting the dollar. The dollar has come off from its peak, and we want to see whether this one will continue forward or not. Okay. Now going into the new week, we are going to see quite a busy week. We have UK, we have claimant counts, and then we of course the unemployment rate. Market was expecting 3.7% for unemployment rate. Then we also have CPI numbers, which is going to be a big number on Tuesday night. And then on China, we have retail sales. Again, we want to see what happens after that. And New Zealand will have GDP numbers, and of course wrap up in Australia we have employment change, and then the ECB interest rate decision. So we have a big week ahead, but on Friday the market should be very quiet. But again, if there's no economic numbers, let's hope there's no other factor that will cause the market to be volatile. And what is Singapore CPI now? I think it's about 3.7 if I'm not wrong. Okay. But I have to check this. I have not kept track of what's the local CPI is. We are almost focused on the United States. So Singapore CPI, let me check. Currently, Singapore CPI numbers is headline numbers is 6.6%. That's even higher than I thought. Okay, but we have known Singapore to have high prices for quite some time now, so there's no surprise here. For January, yeah, there's no update here. Anyway, 6.6% is what I saw from Trading Economics, which is a website that I normally check. So it could be it could be those numbers, 6.6%. Let me check for another source. Again, this is no update from the World Bank. Okay, 6.6% was the last number that I know. When non-farm payrolls counts increase, is it good for equity markets and currency market both? It all depends. Right now, the Federal Reserve is hiking rates, and they want to see lower job creation, and they want to see higher unemployment rate. So if that's the case, then the key question is, what will the Federal Reserve do when they have this new set of numbers? Currently, if you take away the bank run story that I mentioned earlier on, then this set of numbers should cause the Federal Reserve to hike rates. So when you hike rates, it's bad for equity market, it's good for the dollar. But right now with the bank run, I think right now they have another set of problems that they have to deal with immediately, because sentiment right now is pretty poor. Everybody is worried because there was another news that came out just hours ago that there's this Coinbase has this there's a company called Circle. For those who are into cryptocurrency, they have a more than $2.2 billion parked with SPV, SVB, and this money right now is in limbo. So will that cause a contagion in the crypto markets? Over the weekend, we did not see it because crypto actually managed to rebound somewhat on Saturday, and today is a bit weaker. But on Saturday, we see the crypto market also sell off on Friday, but now over the weekend, it managed to rebound, stop falling. But with this new news, maybe it will start to fall again. Okay, so be very, very careful because it's affecting across all asset classes, and I think this is going to be the main focus going forward. Right now, let me share with you my chart here. Can you see my chart, my trading view chart? If you can see it, can you just type yes in the chat box? Thank you very much. And this is the this Bitcoin, sorry. I'll show you the Dow Jones first. Now, Dow Jones, you can see that the entire week, the market, except for Monday, you see what happened on last week. Last week, we have Thursday, Friday have managed to run up. And I was very happy to see that because I thought, okay, the market have a three-way pullback. And although it did not quite exactly hit my ideal price, the market looks like that it may have a chance to actually continue higher. Monday, it did. And then it only can manage 33,572 and then close with exactly what we see at the bottom of this move here. Okay, this is a what I call a doji, and we have a doji at the top of this move here, and I thought, oh, this is bad news. And true enough, on Tuesday and right after the Fed chairman testimony in front of Congress, market started to come off. Okay, and it accelerated on Thursday and then on Friday itself. So right now, we are still in a three-wave pattern, but this three-wave pattern now looks a little bit like it may accelerate to the downside. So you can see how much sentiment have changed in just over the weekend. Before the weekend, last weekend, we can see that the market was actually getting ready to charge higher because we have a three-wave pullback. Technically, it should have hit a bottom, and then because of the 2 days of rise, it actually caused the market sentiment to shift to the upside. And then on the Monday itself, the market did not quite go up very far. It actually ended up with a technical, we call it a candlestick that's actually a negative candlestick that's actually not very friendly to further rise in this asset class here. And then we can see markets started to sell off, and this is causing a bit of a problem when we look at the weekly time frame. Okay, this is a weekly time frame. This is an ugly bar here. So if this is a three-way, we shouldn't be seeing a bar so long. Okay, but things can happen because on a week-to-week basis, from last weekend, the market ended on a very positive note, getting ready to charge higher. And this weekend, we have the exact opposite, looking at the market may actually continue to slide even further. Okay, so for all we know, the market sentiment may change. It all depends on what the FDIC do to contain the fear of a bank run. Okay, if they come out with a viable solution, they can actually arrest the sentiment, then maybe the market may stabilize. Again, we will have to see what comes out from the government agency here. One other thing they can do is for the Federal Reserve to do a rate cut in an unscheduled FOMC meeting. Right now, the FOMC meetings are all scheduled ahead of time. So it's not unusual for the Federal Reserve to do an unscheduled rate decision. Okay, and that would be something that the market would actually be happy to see. If they cut interest rates in an unscheduled manner, then they may have sent a signal to the market that everything is going to be okay. But to me, that signals something even worse, because if they actually do that, it's telling me the problem is more serious than we thought. Okay, so there is a pro and cons of doing an unscheduled rate decision before the FOMC meeting is due. Remember, the FOMC meeting for this month is due on March 22nd. So we have 2 weeks before we can see the Federal Reserve actually announce their rate hike decision. Okay, so if they do it ahead of time, that could be both a good thing and a bad thing, depending on how market participants perceive that to be. Okay, to me, that is signaling that the problem is a lot more serious than we thought. Okay, because if this thing spread over to the other major banks like Wells Fargo, to JP Morgan's, to Chase, and then that would be a big problem, because then it will spread globally. Okay, right now it's contained within the United States. We want to see how bad is bad. Okay. So based on this structure here, on the weekly time frame, this is definitely showing us to be a bad development. Although the month is not over yet, but this is becoming quite a serious situation here. We could see a three-way pullback all the way to 26,500. Okay, based on the monthly. If the month ends right now, okay, this is exactly what we see. Then it's definitely going to be looking like we're going to do a three-way pullback all the way to 26,420 based on the structure. But if you look on the daily time frame, it is still a three-wave. Okay, so there is every possibility that it can still be contained. But definitely, if you are holding long position, you'll be feeling very uncomfortable knowing that there is a bank run going on, because those depositors who have not withdrawn from the other major banks now will say, I want to play safe. What if everybody else go to all their banks and started to withdraw just to be on the safe side? That is a classic bank run, and I think that's the last thing they want to see. So they have to stop customers from going to the bank to withdraw their funds, because if you have a lot of money stuck in the bank, you see the FDIC only guarantees up to 250,000 of deposits. Beyond that, there is no other compensation. Okay, and even if you're going to be paid to be covered by the FDIC insurance policy of 250,000 for venture capitalists. Definitely, they have more than that in the bank. They have millions and millions of dollars stuck in the bank. So there is no consolation for big depositors who wants to play safe. They may decide that they want to be safe. That's the reason why gold market actually spiked when the dollar went down. When the dollar goes down, usually the gold market will actually rise, and this time it's rise not so much on the dollar factor. It rise because everybody right now is jittery. Okay, they want to seek safety right now. Imagine you are in a cinema and somebody shouted fire, and there are only 2 exits in the cinema. What will you do? You will normally rush for the exit, and this is what we are afraid. There's going to be a stampede at the exit there. Okay, so this is exactly what I think the regulators and the government agency is trying to prevent. And good thing is they have over the weekend 48 hours to work out a plan to see if they can implement before the market opens on Monday, which is tomorrow. Okay, so we will have to watch for news. Watch your news, glue to your screen if you have to. Okay, now the gray bars are blocking the chart. What gray bars? Oh, you mean this one? Or move it somewhere. Okay, hope it does. Yeah, okay. Hopefully you can see this. Not sure what else I can do. The gray bar. I don't know what is the gray bar. It's either this bar or this bar. Okay, anyway, let's take a look at the S&P 500. S&P 500, this is the daily time frame. S&P 500 looks like it was about to go up as well. And then we have this. This is on Monday itself. This is actually a reversal signal. And the market was actually only managed to go into the midpoint of this rising channel here, and the market broke below the channel on Friday itself, and this is definitely having bearish implication. So we can see that the market here has a 3-wave that is not complete, but now with this move here and the taking out of the bottom from this from the channel, it does not portray a very positive outlook here. So there is the possibility market may actually be coming down. Ryan said that Joseph Gentile is chief admin officer as SVB security product. Yeah, he was a loan officer before he became the CEO. So yeah, jumping from the pot into the fire, yeah. So you can see the the S&P 500 is also having a negative outlook here. When you look at a day on the weekly time frame, you can see that this is quite ugly. This is a outside bar here. We have a high compared to last week, and we have a low compared to last week. So this is definitely not a good sign. So when you see this, you want to be safe. You want to be protecting the downside, because I think the market right now is going to resolve to the downside, more likely to be resolving to the upside, because there is nothing else to hold up the market other than expecting the Federal Reserve to either hold rates and not hike interest. Because if the Federal Reserve are on schedule to hike interest rate in 2 weeks time, or the market expect them to hike interest rate in 2 weeks time, this thing is going to sell off big time. Okay, and the Federal Reserve cannot not hike rates. So right now they are caught between a rock and a hard place, because right now they are seeing possibly a resurgence of inflation in the States, and as the Federal Reserve, they would have to focus on fighting inflation. They have no choice. Okay, but now the high interest rate has actually caused the banking system to break. So would they be forced to actually do a policy reversal? We will really have to watch. Okay. Not sure what they do, but based on the chart, it does not look good. Whereas the Nasdaq doesn't look as bad. Nasdaq, although we have an outside bar on Friday, this is an outside bar, okay, but it doesn't look as threatening as the one that we saw in the S&P 500. S&P 500 really looks bad. When we look at the Russell sold off tremendously. Okay, so Russell is actually the small cap index. It actually is quite ugly. Okay, there was only a 3-wave pullback, okay, to 2007, and this, once it take out 1,642, the market is going to go out to take out a new low. So I think the first market to go into a new low will be probably this index here, the small cap index, which is the Russell 2000. So I think the market now is looking to be quite pessimistic going forward. Okay, when we look at London, London was actually looking quite good, market actually went up to a new high, okay, for the year at 8,044. Although this is not, I think this is an all-time high, correct? This is an all-time high. You can see that the market here has also sold off on Friday. So is that going to be the top for the UK equity markets? Possibly, because the UK market has been unusually bullish throughout this episode here. So right now, because of the sell-off in the States, if it spreads further, it may actually take the FTSE 100 a lot lower than where it is right now, because it's on a relative basis very rich in valuation. Okay. When we look at the German DAX is also now wobbling. The market was at 15,706 and then it started to come down. And technically, it is not that bad yet. This is a weekly time frame. When we look at the daily, we have a gap down on Friday, but still it wasn't that threatening. Okay, but I think now the bias is to the downside if this thing in the States gets out of control. Over in the Nikkei, we can see the Nikkei was actually charging higher. This is the highest it traded for the year itself, 28,735. And then you can see Friday market reacted, gap down and then close on the low end. It started to continue to trade lower. Okay, Hang Seng is definitely top up at 22,700 market. It has a 3-wave rally, and now it's beginning to look like it may continue to resume its larger degree downtrend. This is the larger degree. Maybe I'll show you the monthly time frame. This is how bad it looks. Okay, on a high of 33,484, right now the market is gone this way. We have a rebound here, okay, that has been ongoing for what, four months, and we can see that March has not been February has not been very kind to the Hang Seng Index. Now March is beginning to look like it has already taken out the February low, and it may actually take out the January low. So if that's the case, we may be seeing new low for the year going into the new coming week. Okay, the market continue to trade lower below this level here. This is December. Let's see, this is January. Yeah, if the market goes below this level, it will signal that the market has gone to a new low for the year. Okay, so Hang Seng looks a little bit wobbly. The Chinese market here, this is the CSI 300. You can see that it's pulling back. Although it is still positive, it is still possible for the market to go up, but we have to see what happens in the States. So we can see over in equity market, there is this fear right now. We can feel it in the marketplace. Okay, it's actually quite raw, and a lot of people are mentioning 2008, and that's definitely not a good sign. Okay, let's see what question you have for me. Ryan is saying if they cut rate, that will help with the bank, but it will not allow inflation to continue rising. But it will allow continue. Yes, correct. If the Federal Reserve do a policy reversal right now, that means they pivot by cutting interest rates, inflation is going to come rolling back. Okay, so what it means that the entire year from last March, the aggressive rate hike will be for nothing. Okay, so we are already beginning to see inflation's coming back up again, and then if they cut rate, this is going to ignite inflation all over again, which is what they do not want to see, because that will mean entire year of effort is all wasted. So the odds of the Federal Reserve do an unscheduled rate cut is not very high, okay, and it's quite unusual because the psychological impact is going to be huge, but they cannot not do anything. Okay, maybe the best solution is that the whole interest rate where it is right now, take a pause like what the Bank of Canada is doing. So that would be possibly the best thing they could do, but I think that is not going to arrest the fear in the marketplace. Depositors, the big depositors will want to play safe. They will want to take their money out because they don't know who is going to be next. Okay, if we have another bank failure, the next one on the line people will be watching is this bank called Signature Bank. Okay, and if that one also go under, I think that is the last motivation they need to go out and take the money out from the bank. Okay, so that will cause a knock-on effect. I think right now we are in a precarious situation right now. So they solve a short-term issue to create a longer-term issue, because either way they require to increase the rates in the future. That's correct, Ryan. This is exactly what the market is thinking. Over the long term, I think interest rate is going to go even higher. Okay, market talk about 6% being the terminal rate, but I think the Fed hence may be tight. Okay, for all we know, you see, the Federal Reserve is reacting to market development. They are not taking a proactive approach. First of all, they were behind the curve by as good as 6 months. Okay, after inflation has reared its ugly head. So right now they have tightened. Maybe they have tightened too much without realizing that they have hit a terminal rate. Okay, and this caused the bank to actually fail. And this is a symptom of a policy that they pursue, not relevant to the current market condition. The market is actually quite weak right now. Okay, so Chuan Yu is saying, agree, Ryan. This is the consequence of decades of QE and zero interest rate. Sadly, this management will affect a lot of countries. Yes, correct. Because the US, although the Federal Reserve is theoretically only responsible for the United States, but for practical reason, they are the central banks for the entire world. A rate hike in the States will have repercussion for the rest of the other central banks. They will have to follow the Federal Reserve in lockstep, because failing to do that, they were going to see a massive outflow of funds from the country. Okay, so they will have no choice but to match the US interest rate hike. Okay, and that's causing a lot of problem, because during the period of low interest rates, a lot of corporations and individuals, even governments, has actually take up loans based in US dollars. So right now we have higher interest rate means higher dollar. So they go whack from two fronts. One is higher loan rates, means more money had to be spent on servicing the loan, and then when you have to take your domestic currencies and exchange for dollar at even higher rates, you are beginning to see why Sri Lanka has failed. Okay, Sri Lanka has failed not because of the loan given to China, but because I think most of their loans were in US dollars. Okay, so they did not do any hedge there. So right now we can see that a lot of countries, including Lebanon, including South Africa, now they are caught in the spiral whereby interest rates are going up, their domestic currency is actually weakening relative to the dollar. So we can see that there is a double whammy. Okay. Raja Kumar has asked, does bond investment also covered by Fed insurance? I'm not sure about that, but there is another way we can get, if you're Americans, okay, or American corporations, you want to put your money in brokerage account. Okay, let's say, for example, because the banks right now is definitely not safe. Okay, they are not paying you market rate, although interest rates has actually risen to almost 5%, okay, as far as the Fed fund rate is concerned. But the banks are not offering you those rates. They are offering you a lot lower because they can't. Because for one, they are locked into the lower rates during the period of zero interest rates. So when their income is just 0.25%, they can't pay you 3-4% for your loan. Okay, so basically the banks are not paying you high enough market rates based on the Fed fund rates. And right now you can see that the issue here is there's a lopsided in terms of income versus outgo, right? So the banks are not paying. So what you can do is to park your money with your brokerage account. The big one, like the Americans, they have big brokerages. Those are the one that insurance policy, the brokerage themselves actually has this thing called SPIC. Go and Google SPIC, which is a separate insurance scheme for those providing financial services like brokerages. And they, on top of that, they will go to Lloyd's of London to take up some private insurance policy. You see, if you are big customers, you definitely want more protection for your fund. Okay, so the brokerage will have no choice but to go and add on to the already the 500,000 insurance fund, which is already double what the FDIC is providing. Okay, but they will take up even more for those very high value client. Okay, meaning that you have additional protection there. Okay, maybe the first 100,000 will be in cash, 400,000 will be in some kind of share in the company. So at least you got higher protection in that sense. Okay, so definitely this is not a good situation here. Whether bond investment is also covered, I'm not so sure. Okay, but if you buy government bonds, the government is the borrower of last resort. So the government is actually behind those bonds. If you are buying, whether you're buying in a secondary market or through the primary market, you are basically lending money to the US government. So that one, the Uncle Sam will actually guarantee that, but that will mean that you have to hold until maturity. If you buy a 10-year bond, Uncle Sam will say, come back in 10 years time, I will pay you exactly what I promised to pay you on top of your principal, but that is 10 years lockup, okay? David asked, given that recession is somewhat given, won't the US government want to pump money in because of the presidential election next year? Biden probably want to seek second term in the office. Right now, Biden just presented his budget, okay? And the budget is huge. The thing is, where are they going to find the money? The Federal Reserve is not right now, it's on the rate tightening scale, cycle. I mean to say they are trying to unload their holdings of US Treasury. Okay. And if the US Treasury started to issue more bonds, who's going to buy? The Fed said, I am trying to reduce my holding. I'm not going to add on to those. Okay. On the other hand, we have a lot of countries have been unloading US Treasuries. So right now we have a situation, as much as they want to raise more money to pump into the economy, their hands are tied because the Federal Reserve said, look, I am right now in a rate tightening cycle, okay? I want to reduce my balance sheet, not increase my balance sheet. So if the Federal Reserve don't buy and foreign sovereign don't buy, then who's going to buy? So right now we have a very big situation because they have at most 6 months before they must resolve their national debt ceiling, okay? And not so sure this time they can do it because everybody is dumping US dollars, everybody is dumping US treasuries, the banks are not, the primary dealers, the balance sheet cannot support any more buying. So if the primary dealers are not able to buy more US treasury from the US treasury bonds from the treasury, okay, then they have a big problem, right? And the Fed say, like, my hands are tied because I want to reduce my balance sheet too, okay? So this will be a big issue. Not so much as they don't want to raise more money. It's right now, nobody want to lend them money, okay? Right now, even if they cut off the entire military budget, they cannot even cover this hole. And the military budget is huge, $870 billion. Even if they give the military zero increase in spending, they will still not be able to balance the budget this year. Okay, this is serious. Right, in this case, how does Singapore control inflation? Singapore always use exchange rate. Okay, Singapore always have one tool. They don't use interest rate. Government here say, okay, I will make the Sing dollar stronger, because most of our inflations are imported, because we import practically everything. Short of oxygen, I think we import everything. Okay, so in order to control inflation domestically, we have to make sure our currency is strong, so that you lower down the impact of imported inflation. So we use exchange rate. Okay. Chuan Yu is asking, sometimes I question the competency of people in the US Fed, from QE to transitory inflation to soft landing. You are right, Chuan Yu. We have a lot of academia who never work a day in their life. They only live in theoretical world. Okay, you can see all the Fed chairman has never had practical work before. They're all taken from university. They are professor. Okay, so you ask them to manage an economy in real life. Sometimes in real life doesn't perform according to theory, and they are holding on to outdated theory. Now ever since Reagan time, they have believed that there is no consequences for expanding the budget deficit. Okay, and this has been ongoing for decades in this thing called the modern monetary theory, in which they're supposed to be able to print as much money as they like, and then they don't have to have any consequences. That was the day when people are willing to buy US treasuries. Right now, the world worked up to the idea that, oh, you can seize my money, even though I'm not, if one day I'm not in your good books, you decided to seize my assets, even though, we are not at war. That caused the other countries in the world to sit up and say, look, I want to reduce my exposure to US Treasury and to US dollars. That's why we can see this dollar decoupling that's beginning to spread. Okay, so this is a serious issue. These are long-term consequences. So whether the US Treasury can continue to go on the debt binge is now being questioned, because they don't have time. Okay, at most They have 6 months, but they don't want to wait until the very last minute before they raise the debt ceiling. They can raise the debt ceiling, but who is going to buy your treasury bonds? Because when they raise the debt ceiling, they will issue treasury again to borrow. The thing that you want to borrow, who is going to lend? There's a big question here, okay? So yeah, we have totally people who have, you think they are expert, but they are not. I don't think they are expert, okay? From the way they stumble from one crisis to another, they simply sweep the problem under the carpet to let future generation deal with the problem, okay? So why now we'll go ahead and talk about something else, unless there's another question, okay? Where is the treasury for US? There is only debt now. Yeah, this is exactly what I'm talking about. When the US Treasury, which is the finance ministry, they call it treasury, but it's actually the finance ministry, wants to borrow money, they will issue bonds, okay? And when they issue the bonds, typically the primary dealers, because they are categorized as primary dealers, they will have the first bite of the cherry. They will buy from the primary markets and then resell them into the secondary markets and keep the difference for themselves. And one of the biggest buyer of whatever the US Treasury issue, the Federal Reserve actually coming to buy. So you create the debt, I create the money to buy this debt, okay? And then the money get pumped into the economy. So it's basically the left hand borrow, the right hand lend, basically. So it's a very a very funny way to run the economy, okay? So to add on, Daniel, China and Japan, who used to buy a lot of treasuries, are now either stop buying or dumping. That is correct. Not only Japan, Japan has no choice. Japan has been reducing their treasuries for the whole of 2022. But lately in January, they're coming to buy again because I think they are under pressure to continue to buy US treasury. But the rest of the world are not beholden to that, okay, because they are not a protectorate of the United States, okay, because US provide a security shield for countries like South Korea, for Japan. So sometimes under political pressure, they will have no choice but to continue to buy, even though they know that's a bad investment. Okay, so but you can see other allies have no qualms. They have been reducing their holding. Israel has been unloading. So is the so is the Bank of England is also unloading. We have a lot of countries across the world, not just China, okay, are also looking to unload. But because the amount of holdings in their book is so huge, they cannot afford to dump everything at one go, because if they dump everything at one go, there's simply no buyer for it, okay? So they have to progressively reduce their holding over a period of time. The whole of 2022, we see China has been reducing their holding month after month after month. Right now, they have about 800, don't know how was the last figure, $800 billion worth of exposure to the US Treasury. It will take them at least 3 years to go down to zero. Okay, so 3 years is a long time. Okay, so whether they have the luxury of able to reduce their holding to zero like the Russian, we do not know. Okay. Now, how long does it take for other countries to unload significant amount? It's again market forces at play. You want to sell, everybody wants to sell, but who is going to buy? The Federal Reserve will have to come in to buy. And right now, maybe Japan may be forced to buy some. Okay, so there are more sellers than buyers. Prices have to come down. Okay, so you cannot unload everything because there's simply no demand for it, or very little demand. Okay, so it's also subject to market forces. You want to sell, everybody wants to sell, but there's simply not enough buyer. Okay, can they just print money, no issue treasury? This is how they print money. They issue treasury, the Federal Reserve will create the money to buy. That is the printing part. Okay, the Federal Reserve do the printing, although right now they don't even have to print, they just have to go to the computer and press, and money is created out of thin air. Okay, so they have to go through the motion. The Federal Reserve and the Treasury will have to openly wants to raise money by issuing bonds. Okay, then the rest of the world, including the Federal Reserve, will have to go and create the money to go and buy. Okay. Hey, Dennis, from my understanding, the US Fed can print money, but the US government can. Correct. The Fed can print money. The US government cannot, because the Treasury cannot create money. That job has to be with the Federal Reserve. Okay. the government can only issue treasuries. Okay, that is correct. Okay, that is the basic understanding of how this market actually works. Okay. Okay, guys, let's not stay too long in this subject. Okay, for commodities, in terms of energy, we can see that crude oil prices was actually going up, and then this week it come back down again. And I was stopped out on a relatively good position, but I didn't lose money. But I was hoping the market can go up to $82, in which I was looking to unload. But the market can only manage up to $80.90 before it start to wobble. So by and large, I think energy market will stay in consolidation for a while. Okay, so this is a consolidation pattern that we have seen since December of last year. So it's likely to continue. Okay, although I do suspect we are very near, if not already, the bottom in this. Okay, but I think this year we want to stay more. If I want to go long, I'll probably go long in natural gas, okay, rather than crude oil, because I think this year the natural gas will actually outrun the crude oil prices. Okay, we have seen a bit of a rebound from natural gas from $1.96 to $3. Okay, so this is the first leg. Hopefully, this is a three-wave pattern. I'm already long natural gas. I was actually long at a not so good level because I was waiting for this market to actually pull back. And when it finally pulled back, I actually went long. But the market right now is slightly just above my entry price. Okay, we want to see if this will end up as a three-wave, at least to go up to $3.48. Then maybe I will get out of my position and see what happens next. If this market accelerate, then there will be a different story. But I think we are very, very near, if not maybe already a bottom in natural gas. Okay. Over in gold market, we can see that this is the COMEX front month contract here. We can see that gold prices actually surged on Friday because the dollar was declining, okay, on the back of US equity coming down. So everybody right now is getting jittery. The reason why the dollar come off is because right now, going into the week itself, we can see that the market is actually quite bullish, especially after Tuesday Fed Chairman testimonial, because he is so hawkish. That means to say interest rate is going to go up a lot more higher than the market expected. That was his exact word. I think his exact word is interest rate is going to go higher than what most expects. Okay, so that laid the basis for a strong dollar going into this into the middle of the week. Then when the SPV broke out, the news broke out, you can see that the dollar declined. Okay, because that possibility of a 50 basis rate hike now is no longer in the talk. Nobody talking about that anymore. Everybody talking about maybe they have to cut interest rate right now, okay, to save the banks. Okay, so whether they want to save the bank or whether they can save the bank, that is another story altogether. I think they are incapable of saving the bank at this time, okay, because they don't have the tools anymore. Okay, they don't have the finances to do it. Okay, they have to pull out a rabbit from this hat. I don't know how they're going to do it. Okay, so the market actually sold off the dollar on Friday, and that caused the gold price go up. But the gold price go up did not quite impact the commodity market. Commodity prices actually comes down, okay, across the board. So we can say the only commodity that actually went up on Friday was actually gold prices to $1,874.30 basis the front month April gold futures. Okay, so we can see that prices are doing a three-way bounce, but I think it may come back down again. Okay, so structurally we will have to see what happens. So far it's three-wave. Ideally, it go up to $1,880 thereabout. Okay, and then we will see what happens. If market can accelerate to the upside, then it will be a different structure altogether. Okay. Over in the silver market, we don't see a lot of demand. Silver was trading the low end of Friday before it started to bounce. But even the bounce, by the end of closing, it gave up 50% of its gain. Okay, so we can see the silver market. If you use silver market as a bellwether, it is not telling us that the demand for precious metal has come back. Okay, it has not. So across the board, we will have to watch how commodity reacts, even with dollar coming down. Theoretically, dollar comes down, all commodity prices should go up, but we are not seeing that, at least not very visible. Okay. We look at the dollar index. This is the dollar index, which is measured against the basket of other US trading partners. You can see that Thursday, Friday was all the way down, and the market peaks at 105.87. Now, this is part of a move from 168. I have always maintained that the dollar may have already bottomed. So this move here, although we saw 2 days of losses, okay, it may actually mean that we are seeing only a pullback, technical pullback. We will have to see how things develop. So far, it does not look very positive, but this could be part of a corrective move before the key question here is 168. If the market doesn't take out 168, I think the market is getting ready to pull back up again. Okay, so by and large, I'm still technically bullish on dollar. Okay. Now, when we look at currencies, when the dollar pull back, of course, the other currencies will have to go up, but we don't see it very convincingly in the currencies, especially not in sterling. Sterling did not go up very much. It ended up marginally weaker compared to Thursday prices. So we can see that we don't see the corresponding strength in the other currencies when the dollar is pulling back. Theoretically, it's like a seesaw, right? When the dollar goes down, the other currencies goes up, but we don't see it in sterling. So basically, it's not convincing enough. Okay. Over in euro dollar, euro versus the dollar, yes, we see a bit of a strength, but even on the day-to-day basis, on a close-to-close basis, we don't see that much of a gain, a marginal gain. So the market actually end up mixed for the dollar on Friday. Against the yen, yes, the dollar has strengthened. Against the other currency, touch and go. Okay, so there wasn't that much of an increase based on the exchange rate you can see here. Likely the market will be top up at 110 and then prepare to test the lower end. If the dollar comes back strong, I think the market is getting ready to come back down. Okay, Aussie is weak. So if Aussie is weak relative to the dollar, it means the dollar is strong. So there you have a bit of a mixed picture here. So there's no uniformity here because the dollar is strong against the yen, strong against the Aussie dollars, but not so much against the euro and the sterling. So we can see a big a mixed bag here. Okay, against the dollar, you can see it's very clear. It's very strong. Okay, yes, it has not dipped that much. In fact, it has actually registered a high on Friday. Okay, now after the news broke on Thursday, when the SVB said that they may be not be a going concern, the market did not tank immediately. Early in Asia, when you look at the 4 hours time frame, early in the morning, the market actually traded to the high. Okay, Asia was still doing okay. Okay, in the morning itself, it's only coming in the New York session when the market actually sell off. Okay, over dollar Canadian, you can see dollar Canadian is not weak at all. Okay, dollar Canadian actually ends the week mid-range. It actually was higher against Thursday prices. No, this is 4 hours. Okay, we still have a high for the year at 138.62. Okay, but by and large, this has already hit equality point. It has gone a bit higher than what I thought it would at 138. My target was at 138.54. Came out to 138.62. So it's marginally higher. So it will mean that it has hit its target. So based on structure, okay, this will be very interesting. If the market goes down lower and close, let's say below Friday's lowest point, then the market would have peaked at 138.62. Okay, then we may see lower dollar rates going forward. Now, you guys have any question for currencies? Okay, no. Then we can continue to talk about crypto. Now, crypto market actually sold off together with equity markets, and that was largely due to Silvergate. Okay, and Silvergate was the first impact. It came in. We can see that the market started to unravel as on Thursday itself. Thursday is also when Wednesday was when Silvergate actually announced that they may have problems and they're going to voluntary liquidation. So there was a big move to the downside. Actually, I was buying here. Okay, I was buying at the end of this move here, and I'm hoping that market can go back to my price here and for me to get up, because I didn't expect this move to happen. Okay, the market was coming down very neatly in a 3-wave, and I bought somewhere here, and the market went down to what, broke 20,000. Now it's bouncing back. So hopefully we can see this price back again. Right now the market is technically oversold, so we hope that there is some kind of we call it a technical rebound. Okay, so this market right now come down to this price. Okay, it is a lot deeper than I like. It means to say that the market may actually, after a bounce, may come back down again to take out 19,569. Okay, so this rebound ideally unfolds in a 3-wave back to 21,400 levels. Okay, close enough. So for Ethereum, it's the same story. I also bought Ethereum on a 3-wave pullback here to here, and the market went below my price. Now it's above my my entry price, but the market is closed. So I will get out of this position on Monday morning, first thing in the morning, if the prices is still around current levels. Okay, so this is a technical rebound. You can see that on Friday itself, this market ends up with a bullish reversal signal, but the problem here is there is a change in fundamentals. So I no longer want to hold on to this position. Okay, so if the market stays around current price, I will get out first and then play safe and watch again. Okay, so this is all I have for you for the day itself, for all the for the week itself. Any other question you want to ask me? Ryan, if it doesn't goes back to the level, how would you exit Bitcoin? I will have to cut loss. I actually have a cut loss point already in place, but it has not hit my cut loss point. It was very close, but it didn't take me out. So either I got stopped out or the market give me a chance I can exit at my entry price or near my entry price. Any other question? Now I'm thinking because we are ending the first quarter of this year, I'm thinking somewhere in beginning of April. I've not have the date yet. If I'm going to do a class, would you guys be interested? I need to know your level of knowledge before I can actually customize a class for you. So if you can let me know what level you are at. Are you a beginner who knows nothing, or you already have some knowledge and you want to gain further knowledge, especially in terms of fine-tuning your entry, how to decide what to do at any point in time? That would be something I think I can do for you. Sky say he's a beginner. Great. Samantha is a beginner. Beginner means to say I will have to separate you from the rest. If the majority have a bit of knowledge, obviously you don't want to go through elementary again. So what I can do is I can separate two classes, one for the beginner, and then for another class after we finish the beginner class, then the rest can join for the intermediate. Okay. Wow, all of you are beginners. Oh wow, Sky is a challenge for the prop firm. Well done. Like I said, I have this idea, but I have not crystallized. I want to see whether there's demand. And actually, I want to do a physical event, but I do not know where you guys are. And there will be cost consideration, because if I'm going to rent a place, the cost wise will be actually something I have to consider. Okay. I could do one in Malaysia if you guys majority are in Malaysia. If I visit Malaysia, for those who are in Singapore, I am thinking the best kind of environment to learn is actually in a physical environment, whereby we get better interaction. But if the attendance is not very high, then then if the cost is going to be an issue, then of course the most cost effective is do it online like Zoom. Okay. Sky said, I don't know if it's legit because yesterday should be my profit share to withdraw, but it shows on my dashboard that it's on par. It's on April the 8th. Well, if you are April the 8th, is not that far away. Now there are a lot of companies has been doing this. I mean to say that if you can trade, then they will ask you to go through what I call that a transition period to show that you can actually deliver, and they will share with you. There are many. Okay, so we'll see how. Okay, iPhone. I don't know who iPhone is. iPhone say his middle. Okay, Ryan said high demand online. Sojin said online is better. I do understand online is definitely more effective, but but we don't get the same level of interaction. Okay, it's Samantha is Malaysia, which is good. I actually intend to go to Malaysia. Okay. Okay. Since you guys are majority of you are beginner, maybe I'll come up with a maybe an outline for a beginner workshop. Okay. All right, guys. I will talk to you about this once I have crystallized my idea. Once we have done with the beginner, then we talk about intermediate. Okay. Okay, guys. Any other question you want to ask me? If not, then I will wrap up tonight's session. I do have a recording, so if you guys need a recording, reach out to me early. Brian's asking, am I referring to knowledge on fundamental or technical? Both. Of course, we're going to start with fundamental first. Okay. Okay, guys, thank you very much. I'll see you. And for those who wants a copy of the recording, the link to the recording, reach out to me. Okay, thank you. Bye-bye.